All right, let's get straight to it. The big picture is this. The market is completely trapped. You've got massive macro headwinds fighting against a powerful AI tailwind. This is our framework for how to position over the next 1 to 2 weeks.
So how do you trade this market profitably? It's all about filtering the headlines. I mean, look at it. Most of what you see is just noise, designed to get you emotional. Our job, our only job, is to cut through all of that and find the actual actionable signal. Here's how we're going to break this down. First, the market's core conflict. Then, the key catalysts you need to watch this week. We'll follow the money, see where capital is flowing. After that, we'll lay out 3 actionable scenarios, then some risk-defined trade ideas, and we'll finish up with your plan. No fluff. All right, Section 1. Let's really understand the battlefield here, because that's what it is. The market is in a total tug-of-war, being pulled in 2 completely opposite directions.
So in the bull corner, you've got a dovish Fed, this insane AI momentum that just won't quit, and whispers of a potential China deal. But the counterforce is serious. We're on day 33 of a government shutdown, which means key economic data is delayed. We're seeing clear signs of consumer stress, and the market breadth, it's dangerously narrow. I mean, this is a textbook setup for some major volatility.
Okay, so what's going to break this stalemate? These are the events right here. The market is going to be forced to pick a direction because of these catalysts this week.
Look, this week is an absolute earnings gauntlet for big tech. I'm talking Microsoft, Google, Amazon. These names are basically going to determine the fate of the cap-weighted indexes. It's a huge test for the market's narrow leadership. And as if that's not enough, you throw in Palantir earnings and a possible China trade deal? Yeah, that's a recipe for some seriously explosive price action.
You know, while everyone is talking about AI, look under the hood. The consumer is weakening. We're seeing auto repossessions at levels we haven't seen since 2009. And subprime auto delinquencies, they've just hit a 30-year peak at 6.5%. Let that sink in. This isn't just noise. This is a significant crack in the economic foundation.
Okay, so with all that context, let's do the most important thing. Let's follow the money. Where is capital actually moving? And what does that tell us about real conviction, or lack thereof, in this market?
Let's be clear. There is only one dominant theme driving this market right now, and that's AI. Capital is just chasing performance, piling into names like NVDA and Palantir. Yeah, the technicals look strong, but you have to be aware the valuation risk here is extreme. For Palantir specifically, the number to watch post-earnings is $200. That level is going to be the pivot.
At the same time, we're seeing capital rotate out of names with perceived execution risk. Take Meta, for example. It sold off 12% because the market got spooked by CapEx fears. But if you look at the fundamentals, its core ad business is still growing at 25% year over year, and it's trading at a forward PE of just under 22. So what you have here is a potential valuation disconnect that's worth looking at.
Now here's a huge cautionary signal. Sophisticated capital, the smart money, is getting defensive. Berkshire Hathaway is sitting on a record $381 billion in cash. Now this isn't panic, this is discipline. It's a loud and clear signal that they perceive a high level of risk and a serious lack of compelling opportunities at these prices.
This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
Okay, let's translate all this analysis into an actual strategic framework. Enough talk, let's get to the plan. Here are the 3 most likely scenarios for the next 1 to 2 weeks.
So based on all this conflicting data, our base case is that we're stuck in a choppy, range-bound market. I'm assigning that a 60% probability. The bull case, where the catalysts really hit, that's about 25%. And the bear case, where those macro risks finally take over, is a lower probability 15%. This setup right here gives us our strategic bias.
So let's talk about that base case. The key here is not to be a hero. We expect choppy back-and-forth action. That AI leadership, yeah, it'll probably continue, but it's going to be capped by all this macro uncertainty. So the right posture here is defensive. We're talking about holding around 40% cash and making sure you have active portfolio hedges in place.
Now what about the bull case? This gets triggered if and only if the SPY breaks and holds above the key resistance at 690. That move would probably be driven by a signed China deal and just blow out earnings from big tech. If we see that trigger, the plan is simple. Deploy cash into that strength and increase our long delta. But until then, we wait for confirmation. No jumping the gun.
And the bear case. This thing activates if the SPY decisively breaks key support at 67.85. A break there would be the signal that a megacap earnings miss or that worsening economic data has finally taken control. If that level breaks, that's our trigger to get net short and press our hedges. This is the primary risk we're managing against right now.
All right, let's move on to some specific actionable setups that align with these scenarios. And let me be clear, all of these are risk-defined. That's the only way to trade in this environment.
Okay, 3 ideas. First up, Meta. The thesis here is a bullish contrarian play on that valuation disconnect we talked about. A call-debit spread is a great way to capture that potential upside with a very defined risk. Second, Palantir. This is a binary earnings event, right? So a neutral post-earnings iron condor could be a smart way to play for it to stay in a range after the dust settles. And third, the SPY. This is our portfolio hedge. A simple put debit spread gives you defined risk downside protection against that bear case scenario. And for every single one of these trades, there is a clear invalidation level.
All right, let's wrap this up. Let's bring this all together into one final actionable takeaway.
Look, in a market this conflicted, discipline is your only real edge. That's it. The market is going to do everything it can to shake you out, to make you emotional. You have to trade your plan, a plan based on data and levels, not the emotional noise that's flooding the headlines.
Not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.